Alrighty guys, welcome to episode 5 of the series, and today we are going over SMTs. And this is a huge cheat code for using our model because SMTs show us that if our trading model and our entry is going to look good, and this gives us a little more conviction and confluence if this trade will most likely work out. So SMTs are a huge confluence in this trading model, and let's get right into it. Alrighty, so what is an SMT? An SMT is a divergence between two correlating assets, which one asset is the S&P 500 and the other asset is the NASDAQ 100. So what creates an SMT? So let's say the NASDAQ takes a high and the S&P doesn't take that high. That would create a divergence, which is also an SMT, and that would give us more confirmation that the trade would want to go to whatever side we're leaning our bias onto and wherever the draw on liquidity is. So an SMT has to be with your draw on liquidity in order for it to work. Alright, for example, we have this external SMT, which ES on this managed to have this high, and NQ did not take that high. And so this would be a example of a bearish SMT right here. And then you would want to look internally. Maybe we would have an SMT here. You would want to look for an internal SMT, because once we have our external bias SMT, that gives us more confirmation. Then we want to look internal to see if we have an SMT at one of these highs, which we don't right now at the moment, but that is an example of an actual SMT in real time. So an SMT tells you what the true drawn liquidity is. So if one asset takes a higher low and the other one doesn't, then that means we possibly want to see the market trying to fake traders out to then have the actual drawn liquidity, which created the SMT. The reason why SMTs work is because it gives us confirmation that we are then moving to the drawn liquidity, and that was just a manipulation move or possibly to stop out traders going for the wrong bias. So the most correlating assets I use is the S&P 500 and the NASDAQ 100. The reason I use these is because they move together about 90% of the time, and then once there is that 10%, which is a divergence, that is your tell, and that's when you should have your edge on the market, and that is when you enter the trade. You have conviction, this is a confluence, and you're in the trade with stress-free emotions. Alrighty, an example for a bearish SMT, which is right here, because ES did not take this low, which would be right here. ES left this low hanging, created more of low resistance sell side liquidity. ES took the low, then to see a move up because ES was already bearish. So this would be our SMT. This would be a bearish SMT. Let me just have that there. This is a bearish SMT because right when we took it, we saw a bat displacement move, and then now we are slowly consolidating up. Alrighty, now that we have a bearish SMT, I'm gonna go look for a bullish SMT for y'all. Okay, so we do have a bullish SMT right here. So we have this buy side liquidity. Put that up right here. We have this buy side liquidity that in Q it took. Buy side. And then we have this buy side liquidity that ES did not take. And the reason for ES not taking this is because we wanted to see us have a move lower. We took this buy side, we were already kind of bearish with ES. So in Q, instead of ES taking this high, NQ did, and then ES began to sell off, which is telling our draw on liquidity. So this would be example of a bearish SMT right here. SMT right there. So this is a bearish SMT, and this example is a bullish SMT. Alrighty, so these are the do's and don'ts with SMTs. I'm going to start off with the things you should not do with SMTs. Is you should not just base your trade off of a SMT. You should not enter a trade just because you see an SMT or a bullish SMT. And that just is not how this model works. You're going to have a checklist off. So for example, we have a change in the state right here on the 5-minute, which is right here, change in the state of delivery. We have a fair value gap right here, which we then do tap into. I would target this internal buy side liquidity, and then I would want to have this external buy side liquidity for our second take profit. And a price did tap into this, so if you did size up, that would be perfect. So these are the do's. You should have a checklist out for your SMTs. You should not base your trade off one SMT. That would not make any sense. You should have a change in the state, for value gap, draw on liquidity, internal, external. You should have your actual checklist, and once you check everything off, this is when you enter the trade, this is when you get confident, and this is when you just sit and watch the market. An SMT is like a magic arrow. It's telling you where the market is wanting to go, because when you have all this, it's your final checkbox. So you have your change in the state, fair value gap, draw on liquidity, then you have your SMT giving that final confirmation of where price is actually wanting to go, and that is when you should take your trade. So this is when things actually start to get dangerous, because now you're not entering off of emotions, you're entering off of pure confidence, because you know this trade is going to work out. You're going to size up, you're going to stop being nervous in the markets. That's when you start moving with conviction, and that's when you'll see your progress shoot a huge amount. So this is when your trading journey is going to change once you combine all these together, because trust me, this model is, you're going to stick with it forever, trust me. Alrighty, so now we're just going to combine everything here. So this model is high probability. This model will not work if your psychology is not in check, so make sure you do have your psychology in check. I will be posting more content about psychology so I can help y'all with that, because it truly helped me becoming profitable. And so let's just go off the checklist. So we have our change in the state of delivery, which shows when the market is actually shifting, and then we have a fair value gap, which is a big displacement move, and it has so much value, price wants to tap back into it, and then that's when you get your sniper entries. And then lastly, you have your confluence, which is your SMT, which gives you even more conviction that price is wanting to go to the drawn liquidity, because ES maybe didn't take it, or NASDAQ didn't take it. So that would give you more confidence that your trade may work out. Alrighty, so this is kind of your homework for the week. You can go to last week and you should find two valid setups, preferably two bearish, two bullish, and once you find that, screenshot it so you can train your eye to, and you can fuse this into your brain, this model, because it works. And once you have done this, comment SMT unlocked, because this is a huge confluence and this should give you more conviction in your trading. Alrighty, this was episode 6 of the trading series. Next episode, I'm going to get to how to manage your trades and where to put your entries, where to put your stops, where to take profits, so you stop blowing the actual good setups, and then you will actually make money. This is when money starts to be made. And I'll see you all in the next episode, so I'll see you there.